As many of you know, SCHD has been a long-time favorite of mine and a core holding within my portfolio, and it's also a favorite among the dividend community as a whole, rightfully so. When you look at the performance over the past 5 years, SCHD has traded very closely or even outperformed at certain times when compared to the S&P 500 benchmark. And after all, the ETF offers growth potential, a solid dividend yield, and strong dividend growth. Each year, SCHD goes through its annual reconstitution, where it trades in new stocks and boots out old stocks, all based on its algorithm. And I went through and did a complete video detailing all of that, which you could see, and click here at the top to watch that at the conclusion of today's video. However, as I explained in the video, I was kind of bummed out on some of the changes that happened. And I know they've gone through and done the same exact formula year in and year out, so who am I to question the changes they're making? But when you see a favorite position I've held for a number of years, like Broadcom getting booted out, a great company, technology, which SCHD lacks, also strong dividend growth, getting removed from SCHD, wasn't a big fan of that, but it's part of the algorithm. The other thing that SCHD has offered for a number of years has been its strong dividend growth. I love investing in companies that not only pay a dividend, but pay a growing dividend, and they grow it at a fast pace. I'm not so fixated as much on yield as I am on dividend growth, and SCHD had a lot of dividend growth stocks. However, a lot of those companies got removed with this reconstitution. So although the company, or the ETF, I should say, had a strong 5-year dividend growth rate, I don't expect that to be the case much longer. I expect that growth rate to get slower and slower over the next few years. This has to be the case because when you look at the two largest components that were removed from SCHD, one being Broadcom, the other being Merck, both of these companies have increased their dividend at a strong rate, especially Broadcom, which has a 5-year dividend growth rate close to 20%. The largest position that got replaced with it is Bristol Myers Squibb, not known as much for dividend growth, as they have a 5-year dividend growth rate close to only 7%. How could you expect that growth to continue moving forward, at least over the next 12 months, when you remove its largest position, which was Broadcom, also its fastest dividend grower? Merck had a solid dividend growth rate, close to 10%, and you replace it, the largest replacement was Bristol Myers Squibb. They have a 5-year dividend growth rate of only 7%. So moving forward, I expect that dividend growth to be slower and slower. And although I still see SCHD as a core position, I'm turning my focus to another dividend ETF, which I believe has a lot more growth prospects, especially dividend growth prospects. So we're going to look at that ETF here in today's video. But before we reveal it, do me a huge favor, click that like button down below, subscribe to the channel, and let's jump into it. Hey everyone, Mark Roussin here, back for another video. As always, I'm a CPA and not a financial advisor, so please do not take this as financial advice. And before we begin, let me thank today's video sponsor, which is the Motley Fool. The Motley Fool has a ton of great resources and products, regardless of where you're at in your investing journey, whether you are a beginner or you are an experienced trader. You can sign up right now to receive their 10 best stocks to buy right now by going to fool.com/Mark. All right, let's jump back into today's video, taking a look at another dividend-focused ETF that I like a lot. And again, there's a lot of great low-cost dividend-focused ETF options out there. SCHD, we already touched on. You got DGRW, another ETF I've talked about a lot. How about DGRO, another dividend growth-focused ETF? But none of those are the ETF we're here to talk about today. Today, we're going to be talking about the Vanguard Dividend Appreciation ETF, stock ticker VIG. For all the attention SCHD has received over the years, again, rightfully so, VIG has actually outperformed SCHD by a slim margin, returning 70% over the past 5 years. Looking out over the past 12 months, VIG has easily outperformed SCHD with a near 15% return rate compared to SCHD's 8%. VIG is a fund that was founded back in 2006, so it's been around for nearly 20 years. Definitely not a new kid on the block by any means, but it is a passively managed ETF, not updated all that often, which allows them to charge a very low expense fee of just 0.06%. All right, let's take a closer look at VIG, beginning with its sector breakdown. As you will see here, technology is the top sector with a 22% weighting, followed by financials with 20%, healthcare with a 16% weighting, industrials with 12%, and rounding out the top 5 is consumer staples with an 11% weighting. Very well diversified and spread out amongst the top sectors. Also, when you look at these sectors, VIG can actually complement the likes of SCHD. SCHD really lacks the technology exposure where you get a little bit more technology exposure with the likes of VIG. SCHD, you get a lot more energy, which you don't get with the likes of VIG. This is all very important when you're looking to build a diversified portfolio. You want to have at least some exposure to all the sectors out there. You never know when one sector is going to outperform and one is going to lag. And ETFs are the easiest way to diversify your portfolio. All right, let's take a closer look now at the top 10 holdings within VIG. At the top, you see Microsoft with a 4% weighting, followed by Apple at 3.7%, Broadcom at 3.3%, JP Morgan Chase at 3.3%, ExxonMobil at 2.7%, United Health Group at 2.6%. Then you get a couple credit card companies in Visa and MasterCard, both at 2.4% and 2.3% weightings respectively. And then the final two in the top 10 are the Home Depot and Procter & Gamble, both sitting around 2.2% weightings. The ETF has a total of 342 total positions, with the top 10 accounting for nearly 30% of the entire fund. When you look at this top 10 list, this is a great list of high quality companies. Not only are they high quality companies, but these are companies that can offer growth potential, and most of them have very strong dividend growth prospects. Let's take a look now at those same top 10 holdings, but I'm going to show you their 5-year dividend growth rates. Beginning with Microsoft, who has a 5-year dividend growth rate of 10%. Apple at just below 6%. However, they don't have a lot of dividend growth, but they're returning money a different way, with $90 billion in stock buybacks over the past few years. And then you got Broadcom, which was booted out of SCHD. It has a strong 5-year dividend growth rate of nearly 20%, sitting at 17.5%. JP Morgan Chase at 7.5%. Exxon with only 3%. So that's the lowest on this top 10 list here. But now we're going to get into the nitty gritty where these next 4 companies have very strong dividend growth. You got United Health Group at 16% 5-year dividend growth rate. Visa and MasterCard, both of them having 16% 5-year dividend growth rates. The Home Depot with a 14% 5-year dividend growth rate. And then rounding out the top 10 is Procter & Gamble with a 6% 5-year dividend growth rate. So you get a great mix there of high quality companies, and the majority of them have strong double-digit 5-year dividend growth stocks there. That allows you to put the power of compounding into overdrive. All right, the last thing I want to take a look at is the dividend, where right now you could see that VIG pays a dividend of roughly 1.9% looking back over the past 12 months. The 5-year dividend growth rate sits right around 8.5%, and the ETF has been paying an increased dividend for over a decade now. So you might be asking yourself, well, Mark, SCHD has a higher yield and faster dividend growth, and that is certainly the case. But looking at this stat here, you could see that over the past 10 years, the dividend growth, and over the past 5 years, the dividend growth has sat right around 11 or 12%. But those trends are going down further and further. SCHD has a 3-year combined average growth rate of just 8.5% when it comes to the dividend. Now, when we look at VIG, it's going the opposite direction. That dividend is growing at a faster clip. Over the past 5 or 10 years, only about 8.5%, which is what we just saw here. But over the past 3 years, we are up to nearly 11.5%. Down in the comments section below, let me know, what are your thoughts of VIG? Do you prefer VIG or SCHD over the next 12 months? And if you haven't done so, make sure you smash that like button down below. Subscribe to the channel, and we'll see you in the next one. Take care.